when it comes to investing, risk and return are inextricably linked. There's no way unpairing these two. However, we often get asked by clients, what do we think are the best low-risk investments out there? So in this video, I'm going to tackle that question, and I'm going to tackle it in two ways. So first of all, if you're looking for an investment with absolutely no risk or with as little risk as possible, you're really looking for something more like a bank deposit. The good thing is this now does exist in the ETF world. In fact, in Australia, there are 4 cash-like ETFs out there that really just put your money in short-term deposits and similar types of securities. And so they're backed by banks. They earn a similar rate of return to leaving your cash in the bank, and they don't really vary in share price each day. So the ETF price basically tracks sideways, and so you won't see a lot of volatility. And if you look these up on the ASX, you'll see that they are called either cash ETFs or enhanced cash ETFs. And in the comment section below, I'll leave a link to one of the reviews we've done of different cash ETFs listed on the ASX. So if you want absolutely no risk, that's what you need to look at. If you are prepared to take some level of market risk, then what we would recommend is making sure you've got an asset allocation that's more geared towards defensive assets like government bonds and gold, compared to more risky assets like shares and property. So our most conservative portfolio, I think, is a good example of a lower risk type investment, although I need to really caveat that with it's not a zero risk investment and you will see some ups and downs. But to give you a 10 years of data, our low risk amethyst or our conservative amethyst portfolio has returned over that period on average 6% per year. Now, although interest rates are a bit higher now, the average interest rate over that period was about 1.6%, which meant that this particular ETF portfolio has done about 4.4% better than just leaving the money in the bank over that period of time. Now, that didn't come for free. You actually had to weather a bit of market up and down along the way. The worst drawdown or fall you had to experience and withstand in order to earn that return was about an 11% fall in the months of January to April 2020 when COVID struck. Our most conservative portfolio fell about 11% over that period. But if you're willing to accept that level of market volatility and are looking for a better return than leaving money entirely in the bank, then that may be the sort of portfolio you're looking for, a portfolio that has about 60% in more defensive assets and 40% in growth assets. And we see this as a popular portfolio for those, particularly in the retirement years, and those looking for a decent income to earn some level of market return and have some level of inflation protection without the need to really experience the big market ups and downs that you have when you have a bigger allocation to shares in your portfolio. And that's my tips for finding the best low risk investments and a couple of options in those camps.